Welcome back, you guys, to Andy the Baker Show. We have a lot to catch up on today. First, I want to share with you how my whole portfolio is doing. My Chipotle, my Costco, Google, and Microsoft. I also need to give an update on the Costco sales number for October that's been released. We also have new treasurer appointed by Trump. His name is Mark Bissett, and why the market is reacting so positively to him being appointed, why he has a big impact on the bond markets, on the 10-year notes, and how that impacts our stock markets. And then lastly, we're going to be talking about the Google and the DOJ, how they're pushing for Google to split up its Google Chrome business. How I think that's going to be a huge deal for Google. Let's get it started. We'll talk about Chipotle here. Now, Chipotle stock, I bought into this stock at around $57. It's currently trading around at $62. It's definitely been a pretty decent trade for me. It's gone up around 8%. And when the last earnings report that Chipotle had, I'm going to be honest, I really thought it deserved the pullback that it had because it wasn't so bullish, right? It expected, guided for lower numbers. So I totally understood it. However, this is a company that I actually see it going back, trading at all-time highs again, which is at $69. And my thesis for Chipotle is with the value that they're bringing to the consumers at this current moment in time, I think they can steal some of McDonald's customer base. Right? So McDonald's is a lot bigger than Chipotle by market cap. However, right, I don't expect Chipotle to be bigger than McDonald's. Hamburgers is the ultimate American food. But if Chipotle can steal 10%, 20%, or even 30% of McDonald's customer base, I think we have a big winner here. All right, that's my thesis for this particular stock. This is a company that I told people, right? They're charging you a burrito at $10 a piece for the chicken one, and they're still able to make profit. And I believe I will pay $11, $12, $13 for the burritos. As a result, there is more cash flows to be had in this company. And not only that, the company is building up more stores. They're building more stores domestically and internationally. And one fun fact about the previous Chipotle stores that's been open is that for each store that's been open, on average, typically, they are recouping those investments within 2 or 3 years. All right, those type of numbers I really do love, and I do have some fears about Chipotle. The fear being that there are a lot of competitors in this space, right? You have Qdoba. Man, I tried Qdoba. I think that business is amazing. I think the meat they sell in Qdoba does taste a lot better. That's the worry I have. And there's this one other company, you might have heard about it. Their name is Kava, and they seem to be coming for Chipotle business. Now, I am not as afraid of Kava as much because Kava is way a lot smaller than Chipotle. And I need Kava to become to a bigger size for me to take it a little bit more serious. I'm very happy with how Chipotle is forming. It's $62. I think it can go towards 69, and then from there it's going to make a slow climb. Then the earnings really have to matter there. The next company that I have invested in is Costco. And Costco is one of my biggest holdings, you guys. If you've been following me for a while, you know that I am one of the biggest Costco perma bulls. And here's another reason why. All right, Costco just released their October sales result. And you can see this is a company that people complain that it's too expensive or overpriced. But you look at the performance, right? They reported their net sales for October of $20 billion. And you look at year over year, right? In the past 4 weeks, it had a 4.1% increase in the US. The main thing that I want you to pay attention when you look at this graph is pay attention to Canada and international. And not only that, look at the e-commerce. This is a company that I see growing a ton in international markets. Like, I don't know if you knew about this, but in Costco China, they have less than 10 Costco's there. And I think with the amount of population that China has, the amount of Costco's that can be built in China is a lot more. All right, that's just my thought process on it. So I think there's still more growth to be had in this particular company. And why not? When you go into a Costco, they're charging you on average about 11% margins, whereas their competitors are charging you about 25 or even 50% margins. Now, the reason why Costco might be charging lower margins, you might be wondering, is because their main money maker is the memberships. That's their bread and butter. And a fun fact for you guys, out of 100 people that sign up for a Costco membership, about 93 of them are going to re-sign for another membership the following year. That type of retention period, that's even better than Netflix. Like, I just gotta love that type of business. And one thing again, another thesis on why I buy this particular stock is because of how predictable it is. All right, and let me explain a little bit on what I mean by predictable. This is a company, you guys, that not only does it make money during good economies like a bull market that we have now, but it also makes money during recessions. It also makes money during, for example, 2020. During 2020, this is a company that still made money, that still increased their revenues when all the other companies were struggling. You look at 2008, this was a company that was still making money at this time. So as a result, the only thing I can be say about Costco is to try to buy more. Now, what's funny about these Costco October sales number is that this is actually a number that's been handicapped. And what do I mean by handicapped? You take a look here. Costco states that October results were negatively affected by a pull forward in sales from abnormal consumer activity associated with hurricanes and port strikes in September. What ended up happening is that when you look at the September sales report, they were a lot better because a lot more people bought supplies in September in preparation for the port strikes and in preparations for the hurricanes. What ended up in happening in October is that there ended up being less sales because those sales in October went to September. Like people bought in preparation. Yet, even then, you look at numbers like these. These are numbers that I, I can only be happy with. Now, on other news, you guys might be wondering why the stock market has recently shot up with the news of Mark Bassett for Treasury. All right, Trump has picked a new Treasury, and his name is Mark Bassett. And 2 weeks ago, you guys probably would have never heard of who this guy is. But the why the market is reacting so positively is because of his stance on inflation and how he is seen as this responsible guy for the economy. For example, one of the things that he believes in is this thing called moving in threes. All right. So moving in threes, what does that mean? According to CNBC, Besant favors a three-pronged approach that addresses worries over the ballooning national debt and deficits, growing the economy at a 3% rate, knocking down the budget deficit to 3% of GDP, less than half of where it stands now, and adding 3 million barrels a day in oil production. So 3% in growing the economy, that's what he believes in, 3% in knocking down national budget deficit, and adding 3 million barrels of oil a day. And as a result, the bond yields, you look at the 10-year notes and 30-year notes, they actually reacted favorably. When I say favorably, they went lower in rates. Now, why does this matter? You guys might be wondering, like, as a stock investor, why should we care about this 10-year treasury? Like, who cares? Like, you don't invest in bonds, so why should Andy care? And it's the reason why I have to look at these 10-year treasury note numbers and also the bond yields is because the 10-year treasury notes are so correlated with our mortgage yields. All right. Now, you might be wondering, Andy, like, you're not going to buy a mortgage anytime soon. You're not going to buy a house anytime. Why does that matter? It's because if the mortgage rates go up for the whole nation in general, then that means less people have buying power, right? Because more of their money is going towards the interest rate. They're paying higher interest rate. So because the demand for bonds and 10-year notes are going higher, these prices are going lower. So the yield, it was trading at 4.41, and today it's at 4.29. So the lower these 10-year notes and the 30-year bonds go, the more liquidity we have in the market. And the higher the mortgage rates are going, that means we have less liquidity in the market because the consumers' money that would have went to buying consumer goods, they would have gone to paying their mortgage off on interest. Now, to give a better example of why the more people buy bonds, the prices of bonds go down. Here's an example, you guys. All right. Imagine I am the government and I'm the city of Andy. Let's just say there's a city of Andy and I need to build more roads. All right. For some reason, I got to build the roads. It has to be built. I'm going to be offering a 10-year note at 4.2 now. All right. Unfortunately, I don't get enough bond yield, like bond people. Like the people don't lend me enough money. As a result, it's like I still need to get the roads built. I have no choice. If demand people don't want to lend me money, then I have to increase the rates. Because if I increase the rates, then more people will be enticed to offer me to buy into but the bonds that I'm selling. As a result, that's why when demand is low for treasuries, their prices, their yields go up. But then when demand is high, when more people are buying into bond yields and 10-year notes, then you see their yields dropping. All right, that's kind of how it works. Now, when there's a lot of demand, for example, in the same scenario, I need to get a road built. I'm offering 4.29, but I realize so many people want to buy these bonds, and I don't need any more additional money. But what I'll do is, okay, since there's so much demand, people want to lend me money, I will give them a lower yield to try to offset that demand. And in my portfolio, 2024 has been the year of Google because Google has been giving me, it's been on the news left and right. And that's something that in my companies, I am just not the biggest fan of, you guys. I don't want to be, although I love Google and the products they have, it's just like every other month, I feel like Google is in the news for something. And this time, it's that the DOJ is pushing for Google to break off Chrome browser after antitrust case. Now, this is huge to me, all right, because if this actually does happen, it will impact Google at a very crucial time when they are trying to set up AI. And with Google Chrome, although it doesn't generate any money, it's the gateway to Google search, it's the gateway to a lot of their money making businesses. And even if you were to sell off, let's say, Google Chrome, the people that can actually buy Google Chrome are the big boys, right? There's no small company that's going to be able to buy Google Chrome. They won't be able to afford it. Essentially, if this actually happens, you're going to be making Google smaller and you're going to make another big rival of Google bigger. It doesn't make sense. You're making one monopoly to another monopoly. That part didn't make sense to me. I know Google is going to fight tooth and nail for this lawsuit, right? That they're going to try anything in their case to not break off Google Chrome. Because one of the arguments that Google has released is that they say they have been trying to work with the DOJ on alternative methods, right? They're trying to cooperate. Hey, whatever you're asking for, we'll change it, right? But the DOJ is bent on breaking something up for Google, right? Whether it's the Google Chrome browser or whether it's the Android portion, they want to break something up. And that's one of the biggest complaints that Google has, that like DOJ doesn't want to work with us. They just want to break us up. And another argument that Google has on their side is that they look at other monopolies in the US history. You look at the Rockefeller oil tycoons, you look at Microsoft that was going through its monopoly case back in early 2000s, early 2000s, late 1990s. And the argument that Google makes to the regulators is that we are nowhere near the size of Rockefeller or nowhere size the market share of Microsoft during their peak monopoly cases. Google's whole argument is that, hey, DOJ, if you want to so Google's whole argument in this whole case is that, hey, DOJ, if you want to break us up for being a monopoly, this would be an unprecedented case because this would be the first time you break up a small company before they even become a monopoly. Whereas with Microsoft or Rockefeller, they had a lot more market share of the business before you broke them up. Now, during this whole time, I've actually been buying a little bit more into Google because the likeliness of Chrome actually being sold off, I just don't think the chances are high. All right. I could definitely be wrong and get burned. But in my case, it's the people that can actually buy Google Chrome. Is the DOJ gonna allow that? Do you want Microsoft Edge, Microsoft to buy Google Chrome, or do you want ChatGPT to buy, or Amazon to buy into Google Chrome? As a result, it just seems unlikely. And another case is like when somebody buys into Google Chrome, right? It's not gonna be as beneficial for that company as it is for Google. Because right now with Google, the Google Chrome is connected to everything, right? It's connected to their cloud storage, it's connected to YouTube, it's connected to the whole industry. It's not a Lego case, right? It's basically everything is connected to each other. If somebody was to take Google Chrome and try to put it, for example, in Bing, it would be a little bit clunky because the whole systems is not was not created for a Microsoft family. That's another thing that I believe that's going good for Google. I ultimately do believe it, but this is a company that's definitely been a little bit more and more unpredictable. The best example I can think about this when I'm investing in Google, when I'm buying more of Google, it reminds me of Amazon about a year or 2 years ago. I don't know if you remember, but back in 2021, Amazon has literally just moved kind of sideways. Right? If I pull it up on Robinhood, you take a look at the 5 years, and for a long period of time, from 2020 to basically 2020, early 2024, it's kind of just moved a little bit stagnant, right? Moved about the same price as it has been. That's something that makes me believe. And you look at Amazon now, Amazon right now looks just like amazing. And that's the hope that I do have for Google, that it's going through a rough time period right now, but in the end, it happened to get past through this issue. Because once it's passed through this issue, I am very bullish on Google. The Google Cloud is booming. The Google YouTube business, the premiums, they're booming. The ad search business, even though it's going through so much lawsuits, the ad search business is still growing organically. And that's something I'm a really big fan of. And with that, you guys, thank you so much for watching in, and we'll see you on the next episode. Bye bye.